Welcome to the Daily Drawdown, where rising yields and AI leverage are setting the pace. The headline risk isn't just higher rates, it's higher rates colliding with massive AI financing, tighter energy logistics, and a market that still looks stronger on the surface than underneath. Treasury buybacks got a quick reaction, then the market faded it. The 30-year briefly dropped from a 19-year high around 5.33% to roughly 5.18%, then climbed back, while the 10-year stayed in the 4.73% to 4.75% area, and the long bond kept pressing psychologically important highs. That matters because it suggests tactical buying can smooth illiquidity in 20 and 30-year paper, but it can't force long-term rates lower if inflation, deficits, global rates, and term premium are doing the real work. Critics are worried the Treasury is muddying price signals and risking credibility if it keeps stepping in without changing the fiscal backdrop. The limit is simple. The Treasury can buy bonds, but it can't create reserves like the Fed, so repeated interventions that don't stick start to look cosmetic. What to watch is whether officials hint at expanding buybacks again. If yields still don't hold lower, skepticism probably accelerates. The Fed still isn't giving markets a clean path, and markets aren't pricing one. A September hike was being treated as roughly a 30% to 40% probability, with Jackson Hole and incoming leadership expected to defend the 2% inflation target without offering much hard guidance. The practical trigger is inflation math. Strategists warned that a monthly core print above about 0.25% could reprice the market fast toward another hike. There's also a growing debate over tools. A hawkish rate signal, balance sheet messaging, and plain jawboning are all on the table, but none of them are clean and none are politically neutral. For markets, 5% on the 10-year remains the obvious threshold. Closer to 5.5%, the risk of broader equity multiple compression gets much more serious. The most important credit story right now may be how AI is being financed. Broadcom is reportedly exploring off-balance sheet platforms in the $60 billion to $100 billion range to buy GPUs and lease them out, and NVIDIA is reportedly targeting something far larger, around $500 billion. These structures are designed to keep debt off the seller's balance sheets, but the risk doesn't disappear. It comes back through guarantees, residual value protection, and other contingent liabilities if demand softens or the hardware depreciates faster than planned. One Bank of America estimate put Broadcom's possible contingent exposure near $370 billion by 2029, which tells you the scale here. Private placements and IG issuance are reflecting that surge. AI-related borrowing has gone from a small slice of private deals to roughly 42% this year, and average deal sizes have ballooned. Why it matters is straightforward. If the AI build-out keeps compounding, these structures look smart. If there's overbuild, weaker lease coverage, or faster obsolescence in older GPUs, risk migrates back onto chip makers and into the broader credit market. That makes NVIDIA earnings much more than a single company event. The street was looking for roughly $92 billion in revenue, up about 97% year over year, with earnings up about 99%, and options implying a move larger than the company's usual post-earnings reaction. The real focus is not the quarter by itself, it's gross margins staying in the mid-70s despite memory and wafer pressure, management's comments on financing and backstops, and whether demand still looks durable into 2027 and 2028. Jensen Huang's tone matters because NVIDIA's read-through hits Broadcom, Micron, AMD, Arista, Dell, and power and electrification suppliers across the stack. A confident outlook could stabilize the whole AI complex. A cautious one could force a much broader reset. The next constraint on AI may not be capital. It may be permits, power, water, and politics. Resistance to new data centers is building in states including Texas, Ohio, Florida, and Pennsylvania, and a large share of planned 2027 capacity still hasn't started construction. That matters because current financing assumptions depend on projects actually getting built on time. If permitting slips, the pain won't just hit developers. It feeds directly into memory demand, equipment timing, utility planning, and the economics behind these huge lease structures. Index resilience is masking weaker internals. Semis, banks, and industrial leadership have softened even while headline indices stay near highs, which points more to rotation than outright collapse. The warning from technicians and strategists is that momentum under the surface has weakened enough that upside now depends on leadership returning, not just passive index support. In practice, that argues for being selective, with attention shifting toward areas like healthcare, consumer staples, midstream energy, and specific industrial names instead of broad momentum exposure. The consumer picture is still divided, and that's showing up in credit. Walmart missed on comps and the stock sold off hard, reinforcing the view that lower-income households are still under pressure from fuel and living costs. Ross Stores, by contrast, posted strong comps and looked like a genuine share gainer, which is an important distinction because some recent retail earnings were helped by tariff refunds that won't repeat. On the financing side, private credit borrowers are dealing with heavier margin pressure, higher leverage, and more distress, especially in tech and software. The risk here is that higher nominal loan yields don't automatically help lenders if their own funding and warehouse costs are rising too. One reason long yields aren't calming down is that the energy and freight backdrop is still inflationary. Middle East conflict and Red Sea and Ukraine disruptions have cut effective crude flows and tightened refining logistics, while diesel and refined product spreads have outpaced crude itself. Container spot rates have also exploded on key Asia to U.S. routes, which keeps pressure on goods costs even if headline crude doesn't make the biggest move. WTI near $86 is manageable. The bigger issue is that reduced spare refining capacity and shipping stress leave the market vulnerable to another leg higher. In crypto, Bitcoin ripped more than 20% in a week toward $80,000, helped by a weaker dollar, lower hike odds, and heavy short covering. The bigger structural story is perpetual futures, the always-on leveraged contracts that now represent a meaningful slice of global derivatives activity. That matters because growth without clearer regulation means more leverage, more contagion risk, and more pressure on traditional exchanges to offer similar products in a regulated wrapper. Regulatory clarity is still the gating factor. Without it, this remains a powerful but unstable part of the market. That's the brief for today. This has been the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.